For Wisemen, we're going to determine the result at the end of the period. We're going to construct a P&L, that's what's needed to do that, and we're going to construct a balance sheet. And we do this with the worksheet, as we call it. What do we have at the beginning of the period? We have the balance sheet for Wisemen, with on the left hand side all assets, total value 1300, and on the right hand side, the credit side, how it's financed. Now, before we start looking at the 4 financial facts, we're going to open the ledger account. For each account we find on the balance sheet, we create a so-called T account with on the left hand side, the debit side, the amounts we find on the debit side of the balance sheet, and on the right hand side the amounts we find on the right hand side or the credit side of the balance sheet. Now we open the T account net fixed assets on the debit side with 800. Why? Because we find 800 on the debit side on the balance sheet. And we do that with each number. We have the 250 here, we have the 250 there. We have receivables for receivables on the debit side. We have bank and bank. Then on the credit side we have equity, we have the mortgage, we have other loans. We open all these ledger accounts on the credit side and we have payables there. Now for each account we know now what the value is at the beginning of the period. Now we have 4 financial facts here in the month of January, and each financial fact will influence the balance sheet. What do? We make for each financial fact a so-called journal entry. We're going to write down which accounts will change. Let's have a look. The first financial fact is the purchase on account. Wisemen receives a invoice for goods and the purchase price is 75. So the journal entry is inventory, 75 to payables. Inventories is an account that reflects assets. So if assets go up, we have to debit that account, and payables the other way around. Then we have received a bank statement which tells us that we received by bank 50. So we debit the ledger account 50 and credit the ledger account receivables. Then the third financial fact, we sell products on account for 500, while the cost of goods sold is 325. So that's the price we paid ourselves for the goods we sold. Now we ignore VAT here. So what's the journal entry? We debit the ledger account receivables for 500. We credit the temporary account revenues. So instead of crediting the account equity, we credit the temporary account revenues for 500. By crediting this account, we actually are telling the system that equity increases with 500, but we paid ourselves 325 for the goods sold. So these are costs of goods sold. So that decreases the equity. So cost of goods sold is also a temporary account. So the gross profit is here for this financial fact the difference between the 500 and the 325, which is 175. Now of course we send the goods to the customer, so the inventory will go down. We credit the account inventories for 325, the price we paid ourselves for the goods. Then the fourth and last financial fact is salaries. We pay salaries by bank. Salaries is an expense or cost, so it's a temporary account as well. We debit that account and we pay by bank, so we credit the account bank. Now what do we do next? We have here all ledger accounts with all the numbers we copied at the beginning from the balance sheet. We opened the ledger accounts at the beginning of the period. So we had 800 for fixed assets, we had 250 for goods, 50 for receivables, and so on. And the next thing is that we post the amount from the journal entries to these ledger accounts. We didn't use the account equity during the period. Instead of that, we use the temporary accounts. Now the first financial fact was the purchase of goods. So goods was debited for 75 and payables credited for 75. Then we received 50 by bank, so we write down the 50 on the ledger account here on the debit side and on the credit side for the account receivables. Then the third financial fact was the sales on account. We debit receivables for 500 and credit the temporary account revenues for the same amount. Then at the same time, cost of goods sold is an expense, it's debited, and the inventories or the account goods is credited for the same amount. The fourth financial fact then reflects the salary expenses. It's debited 150 and it's paid by bank, so bank is credited for 150. Then what's the result then? What's the new equity? Well, for that we need the worksheet. So how does it work? We determine for each ledger account the sum on the debit side and the sum of the credit side. So let's have a look. We have here net fixed assets. We have 800 on the left hand side and nothing on the credit side. So we write down 800 here and nothing there. Then we go to the account goods. What do we have on the ledger account? Let's have a look. We have here 250 and 75 is 325 on the debit side and also 325 on the credit side. So we write down 325 there and 325 there. Now we do that for each account, and when we finish doing that we calculate the totals, the sum of the amounts in the debit column and the credit column, and they must be equal since the balance sheet is in equilibrium, as are the journal entries. Then in the next step we determine the balance of each account, which is just the difference between the amount in the debit column and the credit column. So the difference between 800 and 0 is 800. We write it here in the debit column, since it's in the debit column there as well. Then the difference between 325 to 325 is 0. Receivables, it's 500. We write it in the debit column since this amount is higher than this amount. Then we have bank, 250 minus 150 is 100. Then we have 400 there, 500 there, 100 there. The numbers are on the credit column, so we write them in the credit column as well. Payables 375, salaries 150 in the debit column, cost of goods sold 325, and revenues 500. Then we add the numbers and we find 875 over here and 875 over there. They must be equal again. Then the interesting part begins. We will determine the result. And that's done by constructing the P&L, where we show the costs on the debit side and the revenues on the right hand side. So let's have a look at the ledger accounts. Is net fixed assets an account of which the amount should be shown in the P&L or the balance sheet? Well, net fixed assets is an asset, so it's not on the P&L. So for each account we have to know whether it is an account that must be shown in the P&L or the balance sheet. Well, all temporary accounts are shown in the P&L. It explains why equity will go up or down. So what were the temporary accounts? That's salaries, 150. It is cost of goods sold, 325, and it is revenues, 500. So by copying the numbers of the temporary accounts, we made a overview of the revenues and the costs. And given that, we can determine the result, because the result is the difference between the revenues and the costs. Now, since the costs are lower than the revenue, it's 475, the sum of the expenses, we have a profit. And the profit of 25 is written in the debit column. By doing that, we make sure that the sum on the in the credit column is equal to the sum in the debit column. Yeah, so again, the totals must be equal. If we would have made a loss, if the expenses were higher than the revenues, then the result would have been written in this cell here. So the firm made a profit. Wisemen made a profit. Then the balance sheet. The balance sheet reflects the assets and the liabilities and the equity, of course. So we have 800 here. We have no goods. We have receivables of 500. Then we have bank 100. Equity we will discuss later. Mortgage 500. Then we have other loans 100. We have payables 375. Then salaries, cost of goods sold, revenues are in the P&L, not on the balance sheet. And we have the result of 25. Now the result of 25 increases the equity. So what's the new equity? The old equity was 400. Since we make a profit, the equity will be higher now, and the new equity is 425. Now if we did everything correct, then the sum on the left hand side is equal to the sum on the right hand side. So the equity over there is equal to the old equity plus the result. And of course equity is also equal to the total book value of the assets minus the value of the liabilities. So there are two methods to determine the value of equity: old equity plus result, or total assets minus the sum of the liabilities.